takes pleasure in attracting a stellar list of speakers that address today's most relevant issues. The club's place as a refuge for rich discussion and networking has never wavered after 123 seasons.
We are dedicated to encouraging debate on the issues that matter to this city, this province, and this country.
The Canadian Club is one of the most important podiums anywhere in the world that a Canadian can speak to, tell Canadians what it is that they think, develop those thoughts. And so I want to thank you for that very, very much.
Please join me in thanking our esteemed panelists today.
Through our programs and events, including our youth and young leaders programs, our diversity partnerships, our joint events, and our media and social media opportunities, we offer you access to dynamic political, social, and business figures from abroad and right here at home.
The platform from which the eloquence of Canada has flowed all of that time, whether it be business, education, politics, sports, arts, and culture. If someone wants to say something to Canadians about this country and about the future of this country, this is the venue you choose.
Hello, and thank you for joining us. My name is Anita McCuitt, and I'm the president of the Canadian Club of Toronto. Canadian mergers and acquisitions are on the rise. In those halcyon days before COVID, there was a lot of deal activity, and then it all came to a grinding halt in March and April. But as the months have gone on, new opportunities have arisen, and we're seeing increased momentum in the M&A landscape. Today, we're joined by a panel of experts to hear their thoughts on recent trends, the effects of the COVID pandemic, and what we can expect going into 2021. Before we dive into today's topic, though, here's some information about how you can participate with us. The click here to switch stream button helps if you find that your internet is slow. The video quality may decrease, but your audio should stay strong. Once you click the questions tab, you can enter your questions in the window and they will be sent right to our moderator, and we really do want your questions. Thank you to today's event sponsors, PwC and Torys LLP. The Canadian Club is a nonprofit, and we have been gathering people together for 124 years, and it's because of our sponsors that we've been able to keep going. Now, to introduce today's speakers. Domenic Marino is National Deals Leader for PwC Canada. Adina Notto is Senior Principal at ONEX. David Skurka is Executive Vice President and Co-Head of the Corporate and Investment Banking Group at National Bank. And Cornell Wright is a partner and the Chair of the Corporate Department at Torys. Today's expert panel will be moderated by Catherine Murray, anchor on BNN Bloomberg. One of the club's traditions that has not changed in this virtual world is a toast that we do to our country at the start of every event. We normally do this in person with the raising of a glass, but since we're virtual, if you have a glass nearby, raise it, make a nod to the screen, and toast to Canada. To Canada. Catherine, I will turn the Canadian Club podium over to you.
Okay, thank you very much. And welcome, everybody. It was so interesting to take a look at some of the facts behind the merger and acquisition activity that probably is surprising to most people in terms of the momentum we are seeing. But we almost might want to go back a little bit in time to the March time period. And Adina, I do want to start with you in terms of almost some of the phases that we've seen when things came to a halt. But yet here we are seeing momentum and robustness heading into 2021. So perhaps walk us through what you've observed.
Absolutely. Thanks, Catherine. And hello, everyone. It's a pleasure to be here today. Catherine, I think you're totally right. When we were all sitting here in March of last year, just putting ourselves back in that spot, the world had just shut down. We were being told by the World Health Organization that this pandemic had something like a 4% mortality rate. Vaccines, the history of creating vaccines took years. There had never been an example of it taking months. In fact, the norm was really close to a decade, and the market was falling 35%. I don't think anyone could have predicted, sitting in that spot at that point in time, that we would be where we are today, with the Dow reaching record highs, the capital markets, both equity and debt, sort of roaring back, and deal activity really being quite decent for this year, all things considered. And I think you're right. It really did take a few phases to the year. So March and April, from our perspective, was all about assessing what we had in our portfolio. It was very internally focused. It was, and I suspect it was the same case for corporations as well. This wasn't just a private equity issue. It was all about assessing what you had in your portfolio. What did your liquidity look like for the long term, because it was very unclear how long this would take. Were there any covenants that people should be concerned about? How do we develop cost mitigation plans? How do we understand the government aid programs that were being announced and how we can put those to work towards our portfolio companies? And really it was this effort to what we call lower the resting heart rate of the businesses. And really bracing for what could have been, and still is, obviously 9 months in, a long-term issue that we were facing. And then I would say closer to April and May, the focus shifted a little bit more outward and thinking about, okay, what opportunities are there in the midst of all this? What kind of companies might need our support? Where we can lend a hand and find a good opportunity amidst all this. And then when the government aid programs really took hold, and the markets, both credit and equity, were able to see through the black swan event a little bit. There was a promise that there would be support until we got to the other side. We saw the markets open more broadly. And that brings us to the latter phase of the year, which really kicked off in June and July, where the markets turned. And a lot of deal activity did resume. I mean, you could say that there was a lot of activity in hot sectors. Certainly there was a bigger preponderance towards technology transactions, healthcare transactions, FIG transactions, more so than the normal course and in past years. But deal activity really has resumed in the back half of the year.
And David, from your perspective as an investment banker on the sell side, what have you seen in terms of almost, when we think about the robustness and momentum, you want to see it from a healthy perspective as opposed to a need-based perspective with insolvencies. What have you been seeing over the past number of months?
Yeah, thank you, Catherine. So just to piggyback on something that Adina said, I mean, we really saw 3 years in 1 year, quite frankly. So a very, very robust, start of the year. March, we really pivoted to a restructuring focus, quite frankly, because we did think that there would be more insolvencies than actually happened. And then the latter half of the year has really been very, very robust. So really, in all told, quite frankly, quite a whipsaw in terms of the year. I mean, the fact that the central governments, the central banks in particular, have been flooding the market with lots of liquidity, it's actually helped. And I have some bias here, being from a bank. But the bank market has been quite liquid. We did see a blip in terms of cost of funds and some pricing, but really we're back to pre-COVID levels in terms of bank spreads. And a functioning lending market really does help with deal activity, quite frankly, and it helps with credit markets in general. We've seen a very robust equity market, maybe a little more sectoral focused, but if you take a look at some of the transactions, in particular, one major transaction that was announced a few weeks ago. Intact buying RSA PLC, they effectively raised $4.5 billion of equity capital very, very easily to do a very groundbreaking acquisition. So lots of capital out there for sure to do deals, and certainly as that liquidity continues to put into the market, we don't really see that abating at any point.
Cornell, from your perspective as well, the legal side of deal making. What have you been observing? And, if we go back to, what happened in March and the concerns surrounding insolvencies and restructurings, it seems as though the fact that perhaps that didn't happen to the degree that anybody was almost planning for might have been a surprise. But what did you see then? And perhaps even thread it through to today in terms of, does that aspect still concern you, or are we past it given all the government support?
So our restructuring and insolvency group has had the busiest year on record, but most of the work has been trying to find solutions instead of actually pursuing filings. And that's really been the story of the year. I think early on, people weren't quite sure how this would play out. And there were some filings that did occur, but most of them were companies that were already in effect in trouble and dealing with sort of more fundamental problems of their business. It might have been accelerated by COVID, but it wasn't a function of COVID. In the early part, people were very focused on liquidity and how to manage that. And for the most part, people were able to find solutions. But I think, people in the next phase were in a sense treading water and not quite sure how long this would last, what they would need to do. In terms of why there's fewer filings, I can think of at least 3 reasons. One is I think people generally have viewed it as a bad time to sell assets. Creditors have been reluctant to push that button in a circumstance where it's a bit unclear what would be realized on the other end. Secondly, I think there's been an overwhelming sense of responsible corporate stewardship with strong political and social pressure to be responsible citizens. And you've seen that reflected in the patience of institutional lenders and banks who have been, really approaching distressed files differently. And then obviously there's also been, a tremendous amount of government support, which is, time limited, and some of it will have to be repaid. But there's a lot of things that have, I think, helped to keep things afloat. And there's a bit of a question mark as to what will come next. But I think 2021 isn't particularly going to be about liquidity. I think it's more going to be about viability for some of these companies that have made it into 2021 and are really dealing with a more searching question as to whether the business model they had in 2020 that they've managed to preserve is really one that will carry them into the long term.
Interesting point. I want to just pick up on that for one moment before we go to Domenic, but why is it, we can think of this from a tech perspective and a work from home perspective. At the same time, we've got potentially a COVID-19 vaccine coming about. Why is it, and what kind of industries or sectors are thinking about whether or not their business model in 2021 will work?
Well, I mean, if you took an obvious example of retail, there's a lot of small retailers, and, that business is tough in the best of times. And, it's a bit unclear even, what the trajectory of recovery will be in 2021 and to what degree customers will flow back into stores. And if you've got a business that's got thin margins to start with, and then you're only getting 90% of your sales, that may just not be enough. But David and Adina should comment.
Mm-hmm. Before we do that, maybe let me go to Domenic, because it's interesting when we think about the recovery. Domenic, your area of expertise is Asia Pac, and it's been quite astounding to see the economic rebound out of China. So what can we learn from their experience that you would maybe translate to the conversation as it relates to 2021?
Yeah, for sure. Thanks, Catherine. So I wouldn't say my area of specialty is Asia Pac, but as a global firm, one of the benefits that we have is being able to really speak with our colleagues out east. And frankly, that's the first place we looked when this hit. Didn't know what was going to happen next, and so we were very close with our folks in Asia Pac. And what I could tell you is certainly there was not a uniform story across the region, and unsurprisingly, M&A activity was very much correlated to the respective countries' success in controlling the impact of COVID. But generally speaking, what I'd say is that most were generally pleasantly surprised at the level of M&A activity that returned really after that first Q1 lockdown. And much of it was really attributed to, shelved deals that were brought back online, net new deals coming to market from sellers trying to take advantage of, the shortage in quality assets and high valuations. And frankly, COVID-related M&A, whether it was consolidation plays to improve scale or frankly, looking to carve out some non-core assets. So if we look at it on a more specific country by country basis, I don't think many would be shocked that China is really leading the charge. Again, not surprising when you look at the country's success in controlling the virus. And so while other Asia Pac countries like New Zealand, Australia, India are just recently seeing a pickup back to 2019 levels, China actually saw Q2 and Q3 exceeding 2019 levels, which was pretty amazing. They moved from defense to offense very, very quickly. The last thing I'd say is that we're also tracking, sector perspectives and consumer sentiment. And I don't think we have time to go through all of the sectors, but one interesting tidbit that I thought I would share is that, China's domestic air traffic is actually back to pre-pandemic levels. So quite interesting. So if we try to learn from China, which was the first hit and now kind of a step ahead of the central and western world, hopefully we'll continue to see a strong M&A market in 2021 in Canada, including a recovery of some of the most hard-hit sectors.
Mm-hmm. Adina and or David, do you want to pick up on any of those topics?
Well, maybe
sorry, Adina, go ahead. Oh, go ahead, please.
With respect to seeing future restructurings than I think any of us might have expected, the one element I'd add is I'm not claiming in any way, shape, or form that anyone buying assets leading into 2020 was underwriting what it would look like to have a black swan once in a 100-year pandemic hit. So that's not at all what I'm saying. But having said that, I think the lessons of the Great Recession were fairly recent history here. And I think there's reasons to believe that that companies, generally speaking, and certainly ones that were impacted by the pandemic, came into it in a slightly stronger position than might otherwise have been the case. If you look at S&P cash balances, they were sitting at $2 trillion going into 2020, which was double where they were back in 2010. So good sort of cash capitalization. There was this recollection of what it felt like to be cash strapped in the Great Recession, and the desire and this sort of consistent positioning, certainly that we've tried to establish for our companies, to be well positioned for when a cycle hit. We didn't know this is what it would look like, but I think there's been this feeling that a cycle would hit for a number of years now. I mean, from a private equity underwriting perspective, I can't remember the last time that we wouldn't look with a fairly decent amount of probability at what a recession case would look like in our modeling. So there was this feeling that it was coming. And I think companies were maybe modestly better positioned. That combined with broadly covenant-light loans that existed, I think there's this feeling that, lenders they're not in the business of owning companies. That's not what they want to do. If there's liquidity available, then I think the preference is to do things like covenant amendments or things that let the company see the other side of this. And there's been a lot of those this year that have helped, facilitate the capital structures of companies.
On capital, go ahead, David, on the capital structure front.
Yeah, I was just going to say, I can corroborate the fact that there was lots of covenant relief granted and appropriately granted, right? Because this was, quite a 8 sigma event that no one could have forecast. My background's a little bit more focused on financial services, and even speaking to, the life reinsurers out there when they modeled pandemics, it was really an esoteric, well, maybe there'll be some event. So no one really could see this coming. I would just like to pick up on something that we've been talking about a little bit too, in terms of today versus the financial crisis. There's really never been as much private capital available as well in the system. So although clearly the pension funds, private equity, ONEX has been in existence for many years, but the amount and there's different sources, but say 2 trillion of dry powder, and it probably understates it substantially, because really the allocations toward private asset classes in a zero interest rate environment continue to escalate. And when you think about even Norwich Bank moving just a little bit of its assets, for example, to more private markets, it's billions and billions and billions more dollars, for example, and just where even CPPI is going to grow to. So having that outlet of more capital providers, certainly has also provided a bit of relief to the system as well, for sure.
So relief to the system, but what's so interesting about that as well are the challenges that it might create. And that's not even necessarily new in terms of 2020. You can go back a number of years, and a lot of private equity firms somewhat concerned about the valuations that they would be paying. It's becoming even more competitive. Domenic, you seem to be in agreement with that. So what does that mean then in terms of deal flow and finding the right opportunities and not compromising on EBITDA margins or return of capital?
Yeah, I think what we've really seen, Catherine, is a change in behavior from buyers. So these high quality assets, as you say, the competition is extreme. And so what we're seeing buyers doing is much more sophisticated, preemptive due diligence. and value creation analysis so that they can strike early. And that would include things like data analytics, looking at consumer sentiment analysis and demographic information so that they can really triangulate around the data and support the investment thesis. So it's just, a lot more diligence and a lot earlier than we would, used to see in the past.
And Adina, why don't you pick up on that? Just some of the challenges and or opportunities surrounding doing a due diligence on a new investment. What does it look like today under COVID?
Yeah, so, it's been interesting because certainly a lot of diligence. There was this element of, needing to look into the whites of the eyes of the management team to really get to know a company. And I think an aspect of that absolutely holds. And I'll come back to that in a second. But with respect to actually doing sort of the technical diligence and getting to know a business as opposed to the team, which is what I'll come back to, that's been transitioned by necessity, but honestly fairly seamlessly to the virtual setting. And what we found just anecdotally is that you actually have more access to management in this COVID world because there aren't competing travel requirements or meeting requirements that people have. You can actually get them for hours on end on back-to-back calls because again, there aren't these other constraints taking up their day and their week. So there have been some benefits on that front. What remains absolutely important because, buying a company is very much like a marriage. You're signing up for a long-term commitment between the owner and the management team, and you really need to get to know each other to make sure that there's full alignment. And that, I think, will always benefit and still very much needs the in-person, over dinner, over multiple meetings sort of interaction. I'm not sure that's ever changing once the world opens up. But certainly some aspects of the work have pretty seamlessly transitioned to the virtual world.
Yeah.
Cornell, from your perspective, or did somebody want to weigh in?
I was just going to say, go ahead.
You go ahead.
Yeah, I was just going to say, Catherine, I completely agree with Adina with, the white of the eyes comments. But what's been interesting is, how innovative and creative companies have been able to really flex during this pandemic. So, now we're doing diligence using drones and even more interesting is using, geospatial analysis. So you're looking at traffic levels around retail sites or, truckloads entering mining operations. So all of that can be measured using satellite imagery. And so what I think is actually interesting is that, we're actually going to be a step ahead from a diligence perspective, even post-pandemic, once, vaccines are available, because, in the past when management teams would, potentially sample one site visit, now they can do, 100%. So it's pretty interesting.
And I was just going to add, I think Adina captured it well. They're clearly, we're clearly missing in this moment some portion of the interaction that benefits from being done in person. But there was a long-term trend at play where diligence and M&A processes generally were conducted virtually on phones and through computer. And I think that there's been a very healthy rationalization of time in a sense that more of what can be done without face-to-face interaction is being done that way. It's actually sped up, frankly, some processes that might have taken longer as people waited so people could travel next week or the week after to have a meeting. So I think coming out of this, clearly there'll be more flexibility for in-person meetings and some portion will return. But I think some of what we've seen on a long-term basis will continue because people have seen the benefits and efficiencies, frankly, of operating in this way.
And I would just add, I know this is, sorry, I was just going to say this is an M&A panel, but, certainly we're seeing that as well in the IPO processes, right, where we would spend 2 or 3 weeks road showing across North America or even in Europe management teams, and now we can really complete it in a week with even more meetings. So it's been a real accelerator for some business activity, for sure.
I do have a question from the audience, so let me ask it. I'm not sure. We'll see who's wants to answer first. But what is the most impressive acquisition you've seen this year? David, why don't you start?
Well, there's been a lot of activity in the mining space, for example, and a couple of large transactions like Kirkland Lake and SSR were large transactions, with a good gold tape and a good mining tape. So those have been fantastic. I mean, we were fortunate to work on both of those, as well as some of the transactions around Bombardier as well over the course of the year. Very, very complicated transactions that took a long period of time. I noted the Intact acquisition or announced acquisition of RSA PLC, multinational partnership deal with a Scandinavian insurer. Very, very complicated. Very complicated under UK takeover laws, which are a little bit more stringent than here for sure, or prescriptive perhaps is a better way to say it. And lots of capital, lots of support. Oftentimes when someone announces a deal that requires, for example, so much equity, the stock gets under pressure. There was a little bit of pressure, but quite frankly, they really traded through that. Those are some of the highlights out of the year. I mean, it's been a good year. It's not going to be a record year, and one of the things that's missing is that transaction cadence in the energy space. So when I say energy, I mean oil and gas, not power utilities. So we're missing a little bit of that, and we're hopeful that we see a little bit more of that in the years to come, next year and the year after as well.
Anybody else want to respond to that question in terms of some deal highlights? Okay. Just to round up the valuation conversation for a moment, I was kind of curious when you think about the high valuations that investors have to pay, and we kind of touched upon this a little bit, but, are we going to see in 2021 any private equity firms that might start, backing away a little bit? And maybe we've seen that in certain circumstances. I mean, how do you make sure that you're not overpaying, that you've got that competitive edge so that you've got those returns? Maybe Adina, do you want to respond to that?
Sure, happy to take it. And I'm always curious what advisors on the other side of the table see. But from our perspective, our thresholds, our hurdles, our targets aren't changing in any way. We have a duty to our customers, our limited partners, and our investors to deliver certain returns, and that's what we hold ourselves to. So then the question becomes, how do you compete against this evolving valuation backdrop, which I think you're 100% right on, Catherine. And the way we've thought about it is it's certainly about knowing your lane, knowing what you're good at, what you've historically been good at, and developed a pattern recognition in, choosing your spots, choosing them early, thematically, being able to develop a perspective far before it's the market. Frankly, if you're only looking at something when you get the SIM, you've already lost. Is the reality of the market, not just in 2020, but frankly for the last few years. So it's about developing differentiated ideas and doing that early. And when you win, it's still often, not always, but often, because you've been the one to show up at the finish line with the highest price. But to be the winner now means that you've shown up at the finish line with the highest price, and that's because you have a differentiated view of how you can generate value, not because you're bidding down your returns.
I'd echo that. We operate in a very competitive world, but on the other hand, I certainly see in a lot of the strategics that I work with and private equity firms, the really skillful ones, know how to build a relationship over the long term and secure preemptive opportunities. There's lots of merit in that from a target perspective, being able to deal with a single party but yet extract a great deal. But I think that is, even in some of these processes that you see, they're being run in a way that basically invites a preemptive bid. And I think people are being very thoughtful and disciplined about how to get to that result.
So one facetious comment. Oh, sorry, Dominic. I was just going to say one facetious comment and one serious comment. I mean, the easy way, of course, for private equity to be more competitive is just squeeze your banking partners further and add more leverage. But and I say partners, partners for sure. But the other thing is, we are seeing differentiated strategies too. in terms of, there's some very large funds, including the pension funds and some of the large cap private equity players that are looking for longer term investments with lower return thresholds. So that changes the dynamic a little bit in terms of the competition and the ability to bid up. And then, I mentioned this in our pre-call, we're seeing certainly mandate creep in terms of what qualifies as infrastructure, for example. So there's asset classes that, perhaps I'm unimaginative, but I wouldn't have thought would have necessarily been infrastructure. But if you kind of look through, contractual longer term cash flows, a lot of things can be infrastructure like, I guess. So that's I think that's also part of the dynamic, is that the return thresholds can vary depending on the mandate a bit too.
Mm-hmm.
Sorry, Domenic.
No, I was just going to echo Adina and Cornell's comments. We continue to see PE funds being prudent on pricing, and I expect that will be the case going forward. But I think we'll continue to see PE funds and others really focused on the robustness of their value creation thesis, in order to justify the price they're going to pay. And that thesis, historically may have been, focused on cost takeout, and now we're really seeing a ton more focus on revenue optimization, whether it's, improving the digital journey, et cetera. But, we do see prudent pricing, but still very active in 2021.
We're getting quite a few questions, so I do want to address our audience for sure, and maybe just to kind of pick up on that theme. As it relates to partnerships, David, with M&A deals where EBITDA may have decreased and earnouts are used to mitigate risk, how do you balance creativity with simplicity to meet the objectives of both the buyer and the seller? I think, David, this might be directed to you.
Geez, you hope and pray most of the time, quite frankly. We touched on it a little bit earlier. I mean, during the crisis, there were, or the beginning of the crisis, there was some theoretically amazing opportunities, right? As prices decreased with a number of firms, of course, for public companies in particular, very, very difficult for boards to sell at those levels. So a lot of creativity, came into play. I think, part of it is as folks noted, it is, based on relationship rapport and potential value creation as well. We did see, an ebb, of course, in the deals at the the trough of the crisis for that reason to some degree. Again, couldn't match buyers with sellers. Perversely, as valuations go up, the probability of transactions go up, actually, because that is easier to bridge. Again, we're still seeing very, very, very robust multiples. We're seeing good valuations. So that bridge is, sometimes less difficult to cross than it might seem. We haven't really seen any transactions with contingent value rights recently. That's another way to bridge some of those in terms of public company transactions. There's lots of different tools, and we've had to go into our toolkit quite a bit, actually.
One other question from an audience member, and Cornell, this might be directed to you in terms of, or perhaps you can answer. When we think about the Biden administration and being tough on the energy landscape, any expectations for continued acquisitions in the North American energy space? What are we seeing so far? Anything?
Why don't I let David take a crack at that?
Okay.
Well, when you look back, and I have some stats here, so I'm just going to refer to a couple notes because, when you look back at 2016 had about $260 billion worth of M&A activity in terms of in Canada. Of that, about 35% was oil and gas. If we look forward to this year, quite frankly, we're going to probably end the year around 110 or 115 billion. So a good year, more in line with 2011 and 2013 in terms of volume. And thus far, so this is year to date, and we may see something yet. It's oil and gas has been about 13% of the M&A activity. So not quite a third, but certainly a big diminution. What we expect to see is there are some strong companies. So there are many strong companies, and there's a number of weaker companies. We do expect some consolidation for sure in the sector. It's not a dissimilar story to consumer products and some other areas where we do have some very, very strong both domestic and global consolidators that will take advantage of some of the dislocation there. I'm hopeful because I'm an optimist. I have to be in my business, otherwise it'd be terrible. But I am optimistic that we will see some more consolidation and right sizing of companies, right, under the the current pricing of oil and the margins that they're throwing off.
Domenic, do you want to weigh in on that in terms of what if you're looking at the energy industry and what you're seeing, perhaps even from a global perspective?
Yeah, I mean, I think what we've seen in Asia Pac is a few mega deals in that space. Other than that, though, I would agree with all of David's comments, and I think it's still a little bit too early to tell kind of how the new administration is going to impact Canadian M&A.
Okay. Let's, if we can, just because I think there's quite a few questions as it relates to the impact of COVID-19, obviously not surprisingly. One question as well is, does the shift to online because of COVID-19 pandemic hurt the employees of merged and acquired organizations? Is there a lack of transition efforts? That's something that we think about, I think, more from, a human aspect, and also, of course, the negative long-term economic consequences when we think of M&A activity. Does anybody want to pick that up? Cornell, maybe?
Sure. I mean, it's I would say in March, it was clear that as boards and management teams came to terms with COVID-19 and the impact of the business, they were obviously thinking hard, not just about financial interest. They were thinking about making sure that they protected the health and safety of employees. And I think that reflects not only their kind of legal obligation, but also the fact that I think we're in a world today where I think people recognize, this is the ESG movement, people recognize that you've got to make sure you're thinking about all of your stakeholders as you make decisions. Clearly, in the context of M&A, the impact on employees is something that a company has to think about. And it's on the, when a board looks at a deal, they want to look at it in financial terms in terms of what it's going to deliver to investors, but they obviously have to, they have an obligation to think about the interests of stakeholders generally. I think most long-term oriented companies take the position that if they think about their investors, it goes hand in hand with thinking hard about employees and about being responsible in the community, that you can't actually do very well on a long-term basis thinking solely about your shareholders, but clearly you have to deliver an investor return. So I think these things go hand in hand, and I don't think companies don't look at them as being binary, where I'll either create value for my investors or I'll look after my employees. There are obviously impacts on employees in the context of deals, but the theory, of course, is that you're coming out of it with a company that's better, and that employees will have opportunities and there'll be supports to help people transition if they're adversely impacted.
And just maybe picking up on that theme just a little bit too, again, we've touched base, and Adina's probably the best one to comment on this, but especially with private equity, so non-strategic acquisitions, so financial sponsors acquiring companies, sure, there's some cost savings and there could be people redundancies, but it really is about growing the business. And again, we're seeing other pockets I mentioned of capital, growth capital investors. So really, it's actually about expanding employment bases in some cases as well. So not all M&A results in redundancies, quite frankly. Some of it is quite positive and growth oriented for employees.
Yeah, actually, just one comment from me, Catherine. PwC, we just recently conducted a study with the CVCA, the Canadian Venture Capital and Private Equity Association, and what they asked us to do was, it was a pretty interesting task, was to look at the impact private equity has on the Canadian economy. And what we found was quite interesting in that, to David's point around, cost takeout, what we actually found was the opposite. Private equity was actually adding back more jobs to the Canadian economy with their growth plays. So it's a pretty neat story, and it's coming to a theater near you.
I saw that study this morning, Domenic. It was really interesting, and I mean, just from my perspective, not to belabor the point, but you buy companies obviously with the hope of growth, and certainly at the valuations. Just picking up on our earlier point that we're talking about now, you need growth. Every aspect of what we do drives towards it, and that does create great jobs and opportunities, and obviously that's what we're all here for.
And speaking of the contribution to the Canadian economy, let's talk just a little bit about everyone's views as it relates to the fiscal update that we got yesterday. $382 billion in terms of the deficit. And, some would say a lack of a concrete plan for the recovery. What does that mean? What did all of you hear from what we heard yesterday as it relates to your outlook for the Canadian economy? Obviously, it's not going to be concrete. We're still in this uncertain time period. The interest rate environment likely lower for longer. Domenic, why don't I start with you on that question? What did you hear yesterday, and what does that mean for your business? And does it mean you go out elsewhere? Does it mean you go elsewhere?
Yeah, I think, Catherine, it really kind of gets back to what we talked about earlier about, our expectation when this first hit was that we would see, a large number of restructuring and insolvencies, and we haven't seen that. And I think this will just, continue to drive that theme. There are many companies that have strived. There are others that are, using government incentives to preserve their going concern status. And so as these initiatives remain out there, I think we'll continue to see that theme in the marketplace.
Adina?
Yeah, I think it's a continuation of what we've seen this year, frankly, from many governments. And I'd say we're still in the support phase of the government aid versus the stimulus phase. I mean, this is in large part money going to help people fulfill their daily needs, or to help corporations keep people employed so that they can fulfill their daily needs. And in large part, I think that's driven the I'll call it relative stability on the deal making front that we were talking about earlier. And I think it'll elongate that and hopefully get us to the other side here.
And David, from your perspective as well, one of the things that we haven't seen enough of, perhaps, but you would have obviously a closer ear to this, is confidence from company managements to go out there and really invest, business investment. Even since the financial crisis, we haven't perhaps seen enough of that. But where we are today and the circumstances, what are you hearing from CEOs?
Yeah, so there has been, from the beginning of the year, we talked about, the financial health of companies to some degree, that they were preparing. People were preparing after a long expansion for a recession of some sort. So you did have folks with, higher cash balances, for example, than they otherwise would have, and maybe pulling back in terms of some of that property, plant, and equipment investment and the like. I think, for example, the fiscal update and the economic update yesterday actually will provide some confidence for folks to continue to invest. Certainly, we can't completely separate the real economy from the financial economy. There are some very good attributes of signaling the fact that there will be, support at almost all costs, quite frankly, for the economy, which is helpful for signaling for that confidence, that business confidence for people to invest. There are some really great pockets that we have seen in terms of the technology landscape where, there has been investment in artificial intelligence and other aspects that we are seeing some pieces in. And hopefully the fiscal update and the economic update yesterday will inspire a little bit more of that physical plant investment as well.
I'd echo that. I think, although it's easy because the situation is so fluid to say the update didn't answer all the questions, in reality, I think it clarified the government's commitment to provide the support to see companies in the economy through I'm going to call it the health crisis. So that was number one. There's clearly, some disappointment that there wasn't something more specific for the travel sector, and, different groups will be disappointed by what wasn't there. But I think on the other hand, there was also some clarity about what is coming. And there's been a lot of calls from the business community about the need for a more robust national childcare strategy, for example, because people see increasing the participation of women in the workforce and some of the challenges around COVID as one of the ways in which we can actually increase our productive capacity as a country. And so you saw hints of that, and you heard hints about infrastructure spend to come. So there were definitely signals in there. It's clearly a work in progress, but I agree with David that I think people would feel confident that at least we are starting to see and will see more in the budget in the spring, a more robust plan.
And we can't underestimate the signaling effect in economic theory as well, right? Of just that positive position that the government has taken. Quite frankly, you can see, I can't see my stock screen, but it's all green pretty much today, so that's helpful as well. And green screens do create wealth effect as well for the economy, so it is a virtuous circle. It's both are good.
Mm-hmm. So as we think about 2021 and some of the themes, and David, you brought this up in terms of the different definition of infrastructure, perhaps even including school buses. Why don't we talk a little bit about 2021 and expectations, certain themes that they're perhaps pursuing and or expectations. Adina, why don't I start with you on that front?
Yeah, so veering away from specific themes for obvious reasons, I think there's I think the stability that we've all talked about that has contributed to the deal environment in the back half of this year should continue. I think obviously visibility on the vaccine front has been a tremendous boost to momentum and confidence, broadly speaking. And in investing, that visibility and stability is critical. So I think people are just able to take a more run rate lens to the way we're all viewing companies and what we're able to underwrite. And certainly the strong credit markets and equity markets provide continued opportunities to do that, both on the buying front and then also on the monetization front. That's one thing we haven't really talked about, but certainly the strong valuations have been positive from a sell side perspective.
Yeah, we are seeing more and more, fund to fund sales, if you will, right? Where private equity historically may have taken a company private and then sold to a strategic after the hold period or IPO'd a company. We are seeing more fund to fund transactions. And we are seeing, certainly green shoots, more than that in the IPO market in Canada. Certainly from a technology standpoint, there's lots of companies that are looking at going public, that have gone public at very good valuations. I'd be remiss if I didn't also raise the SPAC exit route as well. And there was a transaction announced yesterday with the Lion Electric company being acquired, or the announcement to be acquired by Northern Genesis, which is a New York listed SPAC founded really by executives from Algonquin Power Utilities. So that was a fairly high profile transaction yesterday at a valuation based on 2024. So not only are folks looking through COVID, EBITDA and run rates, but people are looking quite ahead in the future for the opportunities for certain segments to continue to really grow at a substantial rate. We couldn't get through a whole M&A discussion without at least talking about SPACs to some degree.
Absolutely,
a huge deal in the U.S. in particular.
Absolutely, Cornell. What were we going to weigh in on?
I was just going to say I think Adina and David have captured it well. That certainly when we look at and talk to our clients, which run a full range from strategics to financial sponsors and others, we feel quite bullish about the outlook, in part because there seem to be a number of kind of fundamental building blocks in place. You've got people feeling more confident, whether the vaccine is 3, 6, or 9 months away. There's at least a line of sight to an end in real terms. Equity markets have stabilized and recovered much more quickly than expected. You've got a lot of large companies that raised capital, frankly, that have turned out not to need it, and have it and can deploy it. You've got financing markets constructive, and policymakers saying they're going to keep rates low for a long time. You've got firms like Adina's with large amounts of capital available. I think all of those things suggest that we should have a pretty, absent some shock or something, it should be a fairly robust 2021. At least that's what Adina and David are promising us.
Our CEO was recently quoted in a interview, that there is an M&A super cycle still coming. So Louis Vachon is actually quite prescient and quite experienced, given his capital markets background. And all of the attributes that you just mentioned, Cornell, were really the constituent parts for his forecast, quite frankly, around that. So it bodes well, hopefully, for the course of 2021.
David, why haven't we seen the kind of SPAC activity in Canada that they're experiencing in the U.S.?
Next question. No, I'm just kidding. We did have a number of SPACs a number of years ago, and the performance was a little bit perhaps spotty in terms of the ultimate qualifying acquisitions and stock price performance after the fact. We're looking into trying to resuscitate that in the Canadian market. I think having a generalist acquisition view is probably not the right approach. And what we're seeing in the U.S. is many of the SPACs have been raised with either themes or sector specialties, I think, which is quite helpful. So even this one that I mentioned yesterday, Lion Electric being acquired by Northern Genesis, again, there's a thematic piece to it that Ian Robertson comes from the power utility space and really bought something that kind of fits that ESG power mold as well. So stay tuned, Cornell, and maybe we can work on something together. But there should be some coming. There is an aspect to the SPAC piece is interesting. Perhaps interesting only to me, but the fact that public equity investors really either can't invest in private equity directly or need to be fully invested in equities rather than cash. And people may have wanted to take some cash or hold some cash, and this is a way, effectively through a SPAC, where one could buy a public company. But if they don't agree with the acquisition, they can vote to redeem their cash back at the end too. So there was a little bit of that going on as well in the United States. And the last point on it, which is over talking the point, perhaps the regulatory review from an IPO filing in the United States could take months and months and months, 6-8 months, depending. In Canada, as everyone on this call would know, once you file a preliminary prospectus, really in about 2 weeks, you're ready to go, and with comments from the regulator, and start that roadshow. So we can accelerate that to a few weeks rather than many months. So the SPAC craze in the U.S. was also trying to accelerate some folks tapping the market more quickly.
And Adina, I don't know if you want to weigh in on the SPAC front, but let me wrap that into 2 questions that I'm going to combine, given our time frame here. There's a question in terms of just given the industries that we're obviously not even really known about, that of course being face masks, hand sanitizers. Do you see those continuing to excel and accelerate? And will there be merger and acquisition activity in it? And then also in terms of where the activity will it also be in clean tech, given the fact that we've talked about the energy sector volumes being down? Do you see that shift? So Adina, let me ask you to wrap those 3 aspects: SPACs, clean tech, and face masks.
Got it. Okay. So on the SPACs front, it's absolutely fascinating. I think there's been something like 180 of them raised in the US this year alone, representing, I want to say the last number I heard was something like 50 billion in additional dry powder to add to the whole pool that we've been talking about. So, from the perspective of being on the buy side, it's another pool of capital that's out there looking for acquisition opportunities. Looking from the perspective of being the owner of assets that eventually need to be monetized, that's obviously an incremental outlet for that. So some pros and cons there. With respect to the industries that have very explicitly benefited from demand pickup on the back of COVID, I think to a large extent, it's been a one-time jump in demand, performance, revenue, whatever it is, that's now already been baked in. So I'm sure that the owners of those assets will appropriately seek value commensurate with that demand growth. But certainly a lot of companies play into this really across all sectors. So I guess good for those that have activity in that space. And the final question, I don't remember.
Face masks, Adina, face masks.
Yeah, that's what I was wrapping up in that comment. So anything from face masks to cleaning supplies to cleaning services. There's a lot in there, and certainly some businesses where they fulfilled a really essential need, and that demand has really materialized over the last 9 months now.
And just the move to clean tech, ESG, we've got to bring that up in the conversation today as well, of course. Adina, why don't you wrap up on that front?
Yeah, on that one, I'd say it's bigger even than clean tech. Certainly, I think the Biden administration will have a real focus on that, and there will absolutely be opportunities in those industries popping up in the US. But I think ESG is even broader than that. I mean, from our perspective, it's a must focus now, as opposed to a nice to focus. And over the years, there's been real push from the LPs, rightly so, to have it be something that GPs focus on. And I think from an ONEX perspective, we very proudly and I think thoughtfully consider ESG aspects in every investment that we diligence. And that includes both, companies directly involved in ESG causes or directly driving activities along those lines, but then also other companies that have to look at every single ESG component. So we, as I said, are trying, and I think successfully thoughtful on that front, and it's a must-have now. It's the right thing to do, and there's a lot of focus on it from all sides.
Okay. Anyone want to weigh in?
Yeah, I would just echo Adina's comments. We are seeing significant interest from PEs, sovereign wealth, all around impact investing, and asking us to try to help them find green assets, which is not an easy task. And so one of the interesting things we're also seeing is clients looking to buy dirty and sell clean. So take a coal-fired power asset and converting them to running gas or sustainable biomass. So just looking for those kind of diamonds in the rough.
And I think this is all. Certainly we as a firm are really excited about it, because these are all areas, whether it's clean tech or automation or life sciences. These are all sectors where, as I think David said earlier, there are lots of wonderful green shoots in the Canadian economy, and we should, over the next 5 to 10 years, see a tremendous amount of growth and opportunities for all of us who are looking to work with great companies.
Okay. We are out of time, but I always do this on television, so I'm going to do it again here. Let's have 1 minute. Last 2 words of wisdom as we think about 2021 or projections, forecasts, etc. David, let me start with you.
Banks are your friend.
Okay. Domenic?
I'd say stay positive and continue to strike early.
Okay. Adina?
It's been a tough year. We're absolutely not out of the woods yet, but I think there's news that give reason for hope on the horizon. So I think to have that to look forward to.
Okay, Cornell.
We've seen tremendous resilience, adaptability, and I think there's a huge reason for optimism heading into 2021.
Okay. Well, thank you everybody for the conversation. So appreciated and all the insights. And Anita, let me turn it over to you.
Thanks, Catherine. Domenic, David, Cornell, and Adina, thank you for joining us today and sharing your insights on today's M&A landscape and what's to come for 2021. I heard a lot of optimism from this group that today's strong deals market is not just a blip, and it should continue into next year, and maybe we're even on the verge of an M&A super cycle, new term for me. Catherine, thank you once again for guiding today's conversation. Viewers, tomorrow, Wednesday, December 2nd, we host a panel to discuss building a skills playbook for the recovery with panelists from Future Skills Center, RBC, and NPower. And then next Tuesday, December 8th, I'll sit down with President of Loblaw Company, Sarah Davis, for a discussion on leading through the pandemic and innovating into the future. We hope that you can join us for both those events. Thank you again to PwC and Torys for sponsoring today. Our events would not be possible without our sponsors, so thank you for your generosity. And thank you to our AV sponsor, Van Valkenburg Communications and LiveMeeting.ca for making it possible for us to come together virtually today. Guests, thanks for joining us. Stay healthy and stay safe.
Thank you.
Thank you.